Welcome to this video on market capitalization, the true price tag of a company. Market cap is a beginner's guide to understanding company value, size, and risk. When looking at a stock, you should look at the market cap to understand its price tag. A common mistake is thinking that price per share equals company value. For example, Company A's share is $1,000 and Company B's is $1. Both companies have a total value of $1,000. Price per share is just one piece of the puzzle. Market capitalization, or market cap, is the total dollar market value of a company's outstanding shares. This number shows what the market thinks the entire company is worth. It is used to determine a company's size and compare its performance. The formula for market cap is the current share price multiplied by the total number of shares outstanding. Just like with a pizza, the total value depends on the price per slice and the slice count. For example, Company X has a $2 billion market cap, while Company Y has a $10 million market cap. Size matters. Investors group companies into three main buckets by market cap size to understand their stability and growth potential. These are small cap, mid cap, and large cap, like different vessels on the ocean. Large cap companies, the cruise ships, have a valuation of over $10 billion. They are major players in well-established industries with consistent revenue streams. They offer investor rewards with consistent increases in share value and dividend payments. Mid-cap companies, the yachts, have a valuation between $2 billion and $10 billion. These growers are expanding rapidly. They operate in fast-growing industries and are moving toward becoming major competitors. They offer more room to grow than large cap. Small and micro-cap companies, the speedboats, have valuations under $2 billion, with microcaps under $250 million. They serve specific, niche markets and are volatile. While they carry high risk, they offer high reward and greater growth potential. The risk versus reward spectrum illustrates that large cap means low risk, slow growth, and high stability. Small cap means high risk, explosive growth, and high volatility. Market cap is a proxy for risk, and a healthy portfolio balances safety with growth. In the crypto world, new coins are often minted. This requires two calculations: standard market cap, which is price times circulating supply, and diluted market cap, which is price times total authorized supply, or the maximum possible coins. Two factors move the market cap number. Factor one is the stock price, where supply and demand drive the price up, causing the market cap to rise. Factor two is company actions like share issuance, buybacks, and warrants, which affect the total share count. Market cap is not equity value, as the market can overvalue or undervalue a company regardless of its assets. It is also not the acquisition cost. To buy the whole company, you need the enterprise value, which includes debt and liabilities. Use market cap in your strategy to compare similar companies and check for overvaluation. Also, use it to balance your portfolio. Ensure you aren't too heavy on risky speedboats or too conservative with only cruise ships. Key terms include outstanding shares, IPO, dilution, blue chip, and enterprise value. These terms are essential for understanding company valuation and market dynamics. The bottom line is that market cap is a quick way to estimate a company's value. Check the price tag, identify the vessel type, and assess the risk. Always look at the total value, not just the stock price.